At Davos, Switzerland, the IMF stood up and said, the world economy is hitting into the worst economic headwinds since World War II, the worst. And that's why it could be bad news, but depending on how you look at it, it could be very good news.
This is about as macro an environment as I've ever seen. And I think most people's read on it is probably wrong right now. I'm going to take you through a history lesson,
Good.
And then we'll get to today.
That's
and
macro.
I'll tell you why I'm concerned.
Yeah.
So why World War II? World War II was a fascinating period because, like COVID, the entire world had basically been stuck at home or been on battlefields. Everyone came back. There was no supply of commodities and goods. Global supply chains were broken, and everybody came back and started consuming again. And guess what? Inflation went up to 13% or something, maybe even higher. And that period was fascinating because interest rates went up, and the first thing that happened was the economy went straight back into recession and inflation went negative. Because it was a massive tightening of monetary conditions. You raised the cost of goods on people and didn't raise their salaries enough. People couldn't get the goods that they wanted, exactly like now, and everything collapsed. So we went back into recession, and then eventually some better times. And I'll come back into the 1940s and 50s because I think it's a really important parallel that most people misunderstand. The next time we saw anything remotely like this was 1974. A lot of people tell you it's the 70s again, inflation. Well, the inflation episode we had in the late 70s was driven by demographics. That was the baby boomers entering the workforce all at the same time. It was the largest demand shock the world had ever seen. And we had a supply shock of this oil crisis of the Arab oil embargo. That's not repeating now. What is actually more similar is 1974. 1974 was the Arab oil embargo. The price of oil tripled and interest rates went up, inflation shot up, and the immediate effect was the economy went down the toilet. Almost do not pass go. The stock market fell 50%, and the ISM survey, which is a good guide to the business cycle, anytime it crosses below 50, suggests the economy is getting weak. A recession comes at about 47. It hit 30, which was the lowest in all history. And it happened in a space of 4 months, based on exactly the same kind of setup we've got now.
So you're saying that the 70s are now pretty close?
Yes, and inflation fell in 1974 afterwards. People are still thinking inflation goes on forever. It did not, and it did not in the 1940s either. Then the next one up is 1984. We saw an issue where global trade, there was a huge amount of trade disputes. The dollar was pretty strong, like it is now. Interest rates were going up and inflation was high. And everybody was fearing, looking back and saying, oh, we don't want the early 80s, late 70s again, the inflation. So Volcker was tightening rates too much and the economy collapsed. It didn't go to recession because the Fed quickly started cutting rates, but the dollar went up a lot more and created a lot more problems. We ended up with the Plaza Accord in 1985 when everybody had to stop the dollar going up from destroying the global economy. So then the next time we see something similar was 2008. If you remember, the oil price was at $147. Inflation was 6%. The Fed had been cutting into that because the economy was imploding. 2018, exactly the same. Oil prices high, inflation high, the Fed were hiking rates, trying to tighten the balance sheet. And what happened is the economy rolled over really quickly again. Okay, so what's going on here? Why does this phenomena keep happening? Everyone extrapolates inflation out forever. What actually happens is that consumption falls because we've tightened monetary conditions. So tightening monetary conditions to ordinary people means the cost of your mortgage has gone up at the fastest pace in history. Over a 1-year period, mortgage rates have never risen this fast. So any money you borrowed has suddenly got much more expensive. Your wages haven't kept up with the cost of just basic services like food. So you're actually feeling poorer. So you can't consume as much and you start not consuming other things. People overextended on housing because they rushed into housing in 2020 and 2021 and the rates have gone up for them. Also, just the rise in things like the cost of oil has meant that, gas prices, all of this stuff, and then the rise in the dollar, which is a monetary tightening. All of these things get together would suggest that the ISM is going back to 30, which is as it was in 1974, which is a terrifying fall. And it's suggesting that if we're not careful, we could have a very sharp nasty recession, meaning kind of a negative 5% GDP recession. It might be short, depending what the Fed does, and we'll come on to that in a bit. So we've got the setup that we've seen many times in the past. We've got the forward-looking indicators, this monetary tightening, suggesting we've got some real pain to come. Then the anecdotal evidence, we're seeing all the tech companies who were bulletproof laying off staff and giving earnings warnings because everybody can't raise prices enough, so their margins are falling and people have overextended. Amazon said, we've hired too many people. They're one of the biggest employers in the United States. Okay, this is not good. But the answer to higher prices is higher prices. And that's what's happened. And everybody's looking around themselves saying, well, what's going to break? When stuff like this happens, the market goes down, something's going to break. We're looking, what bank is it? What hedge fund is it? The actual answer is, it's the economy. The economy has just broken. And the Fed are going to have to pivot.
And that's what the IMF is saying in Davos yesterday.
They're saying, and it's dead right, the monetary conditions that we've imposed on corporates and people is the biggest tightening in all history. We've also got China slowing down very fast because the lockdowns, but also they've been in recession, and Europe with a war and having to deal with this energy transition. So we've got no leg of global growth here.
Oh.
Now, the question is, how bad does this get? Let's talk some scenarios.
When people use the word recession, that means 2 back-to-back quarters of negative growth.
That's the technical definition of a recession. Yeah. To you and me, I think it means a loss of jobs and a loss in your net worth because it's the falling of asset prices that comes with a recession.
What's the possibility of sliding to a depression?
So depression, I would suggest, is a much longer, more extended period. I don't think that can happen right now. Now, I don't say that with certainty. I never do. Talking probabilities. The reason being is there's one piece of magic, the Fed balance sheet. The Fed balance sheet disguises all bad things because what it does is when they print money, it lowers the purchasing power of the dollar. And most of the central banks at the same time do it. And people always think it's going to be inflation is what it leads to. It leads to something much more pernicious and evil, which is the debasement of currency. And what that does, how it manifests itself, is all of these scarce assets, equities, real estate, gold, crypto, go up a lot. But all they're doing is reflecting the devaluation of the fiat currency itself. So that optically can change everything because suddenly all of these things go up, everybody feels okay, and it changes the outcome. People are still worse off generally, but it's a trick. And so I think that trick gets played again pretty soon. This time I think the trick gets played in a different way, which was the other genie that came out of the bottle in 2020, which the Europeans are doing now, some states in the US are doing, Japan is doing, India is doing, which is direct transfer payments to individuals.
When I heard you talking about that, Raul, I thought you went to the dark side, man. MMT, UBI, and all that stuff, which is to me Marxist. But you're also looking at it from the humanitarian side.
Regardless of what our political or economic views are, this is what is going to happen. So we have to judge it with that lens, not how we would like it to be, but what it will be and what the probabilities are.
I look at the emptying office spaces because people are not going back to work. I mean, this is not an ordinary recession. The Apple says they're not going to go back to work. All the office buildings empty. And, residential real estate depends upon jobs. You know what I mean? If you're saying recession means a loss of jobs, which Amazon's laying off, what happens to real estate wherever they have an Amazon office? This is the ripple effect, which is why I'm saying that was one of the biggest announcements I ever heard, that the IMF is saying the world faces one of the biggest economic challenges since World War II. But one thing that you mentioned, talked about debasement of currency. So here's a penny, it's copper. And in 1964, I was looking at the quarters and dimes, same color. Do you know what I mean? It's the same color. So basically, in 1964, dimes, quarters, and half dollars became copper. And that's what you were talking about, debasement. And I think we're paying the price for it because I'm really glad you started with history because macroeconomics is history. You have to look back in time. And every time people did this, first was the Chinese, they printed paper money and the Chinese empire collapsed. And then when the Romans did the same thing, debased the currency, the Roman Empire collapsed. We're looking at the end of the American Empire.
I think it's going to happen at a shocking speed. So 1974, we went from everything looks okay to the worst recession since World War II in 4 months. I'm thinking it's going to look similar because of the speed of the monetary tightening, the speed of the rise of prices. So I think we are going to have a very ugly few months, both economically and for markets. The question is, what comes next? And that's the key point. If my base case comes into play, which is the Fed pivot, they stop raising rates. They already started suggesting maybe we'll pause in September. My guess is June will be the last hike. And after that, they will say, well, we're just going to see, and we'll see the economy start going down the toilet. And they will start thinking, well, we're not going to do QT now either. So they're not going to start shrinking the Fed balance sheet. And before you know it, we're going to be talking about rate cuts, but we don't have many rates to cut, rates are nowhere. So the only outcome is they're going to have to print money. The credit markets are already starting to dry up. That's usually an indicator. The housing market's rolling over.
Printing money is this stuff here. You have a silver coin, you have a copper coin made silver, right?
That's right.
Basically, it's called debasing the currency, which the Romans and Chinese already did.
Yeah, because don't forget, the debasement of currency works in a simple way. If you're really thirsty and I have a bottle of water, you'll pay anything for it. If you're really thirsty and I've got 5 bottles of water, you're kind of thinking, yeah, I probably need some of that water, I'll buy them all, but at a lower price. If I say, here's 1,000,000 bottles of water, you don't want any of it because there's too much water now. It has no scarcity. So if you make too much of something, it becomes less valuable. So if Da Vinci had created 50 million pieces of art, guess what? They're worthless. And so it's that concept. And what it does is if something gets devalued versus something else, so we're not making more shares in the S&P, actually what we're doing is buying them back, making less of them. Therefore, the S&P goes up. Real estate. Yes, there's periods where we try and create new real estate, but generally real estate prices go up versus the Fed balance sheet because it's a relatively scarce asset. Same with gold, same with crypto. So that's the phenomena. It depends how fast they deploy the balance sheet because this balance sheet magic optically changes markets. And if markets go up, then household net worth stabilizes and spending comes back. Companies stop laying people off. So it's actually a bit of a magic trick.
It comes down, that old saying, the bull goes up the stairs, the bear goes out the window. The bear is about to go out the window. The question is, when does a bull start climbing again, right?
And we either go through a scenario like 2000, which was a typical old school recession where equity markets unwound excesses, the bear market was 18 months or so, and then the Fed keep cutting rates and eventually it stabilizes. But if we look at 2008, which was the next recession, as soon as the Fed used the Fed balance sheet, we pretty much stopped in its tracks. Really quite quick after they did that. They cut rates first, didn't really help because the banks had seized up. Then they used the balance sheet. Then they did it again in 2010, 12, 16, and then 18 was the Fed pivot, the Puoul pivot, where they went from hiking to, oh my God, we need to cut.
Trump yelled at the guy. He says, you cut this out. You're killing my economy.
That's right. So inflation had gone up. The Powell well, I need to do this, but the economy cannot take higher rates because everybody's so in debt and everybody's so old. That is the problem.
So here we are at 2022, right? We have employers not going back to work. So all these REITs, REITs, Real Estate Investment Trust, they own all these office buildings. And then never has the Fed, I think there's a $30 trillion debt now with 200 trillion off balance sheet. And they keep cutting rates and all this. But the question is, can they keep doing the same thing given the conditions of today?
This is going to take us back to the 1940s in a sec. But you're going to get destroyed because of the supply chain issues, because of COVID and all of this. And your wages won't keep up. So we're going to destroy household net worth. And everything's levered. So all the borrowings against houses and all the borrowings against equities and all of the borrowings on top of borrowings. And you're going to let the collateral go down and blow the entire thing up.
But isn't that what they're doing when they say they're going to pay off the student loan debt?
That's debt forgiveness, that's MMT, right? Which is coming, whether we like it or not. What they're trying to do is reduce the debt via financial repression, which is you basically have inflation running slightly higher, so you have then interest rates. So what you want is to reduce the real value of the debt. So if you think back to your parents, how much they paid for a house and the mortgage they had, the mortgage seems laughable. It's because over time, inflation raised the value of the house and the debt doesn't get raised. So in the end, the debt is nothing.
So the way that is this stuff here make the money less valuable.
Correct. It makes the debt less valuable.
Right.
So it's okay if you're in debt, but if you're lending money, it becomes complicated. But the point being is you either have a fiscal stimulus, which is, let's say, the Republican view. We'll have a fiscal stimulus, cut taxes, and we'll put some spending. And what happens is that doesn't go to the people who are the worst off. it's creating this issue of 1% versus 99, which everybody can see and nobody knows how to solve. The issue is actually the balance sheet, because all of the expensive assets keep going up because they keep printing money.
The rich get richer.
But doing this blanket fiscal stimulus is hard because the rich get richer again. So I think people have thought, well, maybe we should just try and give it directly to the people who are most affected. Okay, those are the two choices, or you do nothing, which is too late because there's too much debt. So you can't let the system clear anymore. The old way would have been you let the system clear, it's all okay, you just have a recession, everyone stops borrowing as much money, blah, 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 blah. The world is 400% of GDP in debt. The world has never been this in debt in all economic history. Let's go back to the 1940s now and figure out how bad it was then. This was the very similar setup, the worst supply chain issues, massive inflation, everybody coming back in. Well, what happened was the economy collapsed. Then interest rates came down and they stabilized. And they stabilized because the Fed stabilized them. And inflation was running slightly hot, 3%, and bond yields were about 2%. So real rates, meaning you in the property market, are going to make a lot of money. So negative real rates become very good for assets. And what happened in the 1940s and 50s was a massive economic boom. What we actually got was the value of the war debt eroding because of this financial repression. We had the value of assets like housing. The equity market went up 900% over that period of time. There was a lot of fiscal stimulus because you had to rebuild after the war, and companies were building factories. So if you think of now, companies are going to be rebuilding factories in the United States or in Europe and not in China. So that's going to add some stimulus. Yes, the jobs are not there. It's robots in the factories, but it's still stimulus for the economy. The government will do some stimulus, as we've talked about. Interest rates will remain relatively low. Inflation will remain controllable, but a little bit higher than it has been. And what that sets off is a period of stability and boom, because there's so much technology. There's a lot of big things happening in the world that could be. So that would be my rosy outcome, would be that. And I think that is still my highest probability. That we